Hello and welcome back to another episode on futures and options. I am Kushal Lodha, founder of Kager, an education company in financial literacy, and today we are going to discuss how to analyze open interest for FNO trading to make informed decisions.
So कुशल, hedging एक ऐसा टर्म है जो काफी सुनने को मिलता है, लेकिन सब लोग इसे ठीक से समझते नहीं. Can you break it down for us?
Think of hedging as buying insurance for your portfolio. Imagine you have a prized collection of vintage cars. You would buy insurance to protect against potential damage, right? Similarly, hedging protects your investments from adverse market movements.
That's a great analogy. So कुछ advanced hedging techniques के बारे में बताइए जो traders use कर सकते हैं.
One advanced technique is analyzing open interest in futures and options trading. Open interest refers to the total number of outstanding derivative contracts that have not been settled. It gives insights into market sentiment, potential price movements, and liquidity.
Can you give us an example?
Of course, in March 2023, the Nifty index was trading at 17,500 and the open interest for Nifty futures was reported at 1.2 million contracts. Over the previous week, open interest increased by 15% while Nifty rose by 2%. This indicated that new positions were being added, suggesting bullish sentiment among traders.
तो इस situation में trader क्या करेगा?
A trader could take a long position in Nifty futures, anticipating the upward trend to continue. If Nifty reached 18,000 in the following weeks, the trader could realize significant profits. It's like seeing more cars being insured in a particular area, indicating a perceived increase in risk.
Makes sense. What about specific stock examples?
Let's look at Bank Nifty options in April 2023. The Bank Nifty was trading at 42,000. The open interest for call options at a strike price of 42,500 was 3 lakh contracts, while the open interest for put options at 41,500 was 1,50,000 contracts. The high open interest in call options suggested bullish sentiments.
और trader इससे क्या infer करेगा?
The trader could interpret this data as a bullish signal and decide to buy call options at the 42,500 strike price. If Bank Nifty rose to 43,000, the trader could profit from the call options. It's like more people buying flood insurance when heavy rains are expected.
Wow, that's interesting. What about hedging with put options?
That's a great question. In June 2023, Stock X was trading at Rs 2,400. The open interest for put options with a strike price of Rs 2,350 was 2 lakh contracts. This indicated that traders were hedging against potential declines. High open interest in put options suggests concerns about a downturn.
तो एक trader इस information का use कैसे करेगा?
A trader could buy put options at Rs 2,350 to hedge against a decline. If Stock X fell to Rs 2,300, the trader could profit from the put options, effectively managing risk. It's like buying fire insurance for your home when you smell smoke in the neighborhood.
Quite interesting. How does one combine open interest analysis with price movements?
Analyzing open interest along with price movements can provide a clearer picture. For example, in May 2023, let's say stock Y was trading at Rs 1,600. The open interest for call options with a strike price of Rs 1,650 was 1 lakh contracts, while the open interest for put options at Rs 1,550 was 50,000 contracts. The significant open interest in call options indicated bullish sentiment.
And what happened next?
If stock Y's stock price increased to Rs 1,650, the call options would become profitable. If the stock reached Rs 1,700, the trader who bought call options at Rs 1,650 would realize a profit, confirming the bullish sentiment reflected in the open interest.
It sounds like open interest is a crucial indicator for traders.
Absolutely. It's like the pulse of the market. Understanding increasing or decreasing open interest helps traders identify potential trends and adjust their strategies accordingly.
Are there any other advanced techniques for hedging?
Yes, absolutely. Another technique is using futures contracts. For example, if a trader anticipates market volatility but wants to stay invested, they can hedge by selling futures contracts. This offsets potential losses in their portfolio if the market drops.
So, can you provide a real-world example?
Sure. Let's say in December 2021, a trader held a portfolio of Indian stocks and expected short-term volatility due to an upcoming election. To hedge, they sold Nifty futures. If the market dropped, the losses in their stock portfolio would be offset by gains in the short futures position.
तो ये एक बैकअप प्लान की तरह है in case things go south.
Exactly. It's all about balancing risk and reward, ensuring that your portfolio is protected from unforeseen market movements.
Kushal, this has been incredibly insightful. Any final tips for our listeners on advanced hedging?
Always stay informed and use data-driven strategies. Hedging is about protecting your investments while staying in the game. Understand market conditions, use open interest and price movement analysis, and don't hesitate to hedge when necessary.
Thank you, Kushal, for these valuable insights. Looking forward to our next discussion.
My pleasure.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.